So in the previous video, what we learned is what is inventory means, like how many types of inventory: finished goods, raw material, work in progress, consumer stores and spares, and packing, traded goods kind of stuff. Now we'll be focusing a bit on accounting standard number 2, which says a clear definition of inventory. When I talk about inventory, I should always mention accounting standard number 2, being a chartered accountant or a cost accountant, because we shall do any valuation exactly as per accounting standards. Now says, what is inventory? It says inventory means an asset. We all know it is a current asset. Why current asset? Current asset means an asset which you are not held for long-term purposes, but you held in the business to sell in the ordinary course of business. Say, if I buy a machine to use in my production, that is not my current asset, that is my fixed asset, long-term asset. Hence, it goes to property, plant and equipment valuation, accounting standard number 10. But when I buy some goods, traded goods or material, and convert into work in progress and into finished goods, this is not to keep in my business. This is to sell and make some revenue out of it. So, A2 says assets which are held for sale in the ordinary course of business or in the process of production for sale. Number 1 is finished good, and number 2 is in the process of production for such sale. Means what? Work in progress. And for consumption in the production. For consumption in the production means raw material. So it covers all the three. Number 1, it says to sell, finished good. Number 2, process of production, WIP. And number 3, used in production of goods, consumption in the production of goods. Then it comes under raw materials. Or say to service the goods, like your packing material or your consumable spares, everything comes under your accounting standard number 2 definition of inventory. So, and then what exactly means by valuation of inventory? Why do we value inventory is the next question. As I clearly told you, inventory should be valued for the purpose of closing your financial statements as on the last date of our balance sheet, to identify my closing valuation. We all know opening stock, purchases, direct expenses, sales and closing stock. If we post all, we'll get either gross profit or we'll get either gross loss. So to determine your gross profit or gross loss, you should first know what is your inventory and you should value the inventory. See, why inventory valuation is what the question might come in the examination. Why I should value inventory? Number 1, to determine my income, right? Because your closing stock and opening stock determines your total revenue, gross profit. Yes, and also to know my actual cost of goods sold. We all know what is the formula for cost of goods sold. Opening stock plus purchases plus and direct expenses minus closing stock is the cost of goods sold. And if you add some part of profit to it, you'll get sales. Because sales minus cost of goods sold is nothing but your gross profit. Yes. So you need to do inventory valuation to identify your income and to ascertain the financial position of the company. Your current assets goes to your balance sheet. How much is your liquidity position? So liquidity means what? The liquid position means how good the company is in repaying its current liabilities. If your current assets are more, you can easily repay your current liabilities. It's like current ratio. We call it as current assets divided by current liabilities is current ratio. The more the current assets over current liabilities, the company is always in a position to repay. It says like we are liquid. Beyond all the things, we also need to comply the statutory compliance, as like Companies Act says that the account shall be prepared as per Schedule 3 and also in compliance with the accounting standards. Hence, we need to prepare our accounts exactly as per the policies which are prescribed in your accounting standard number 2, inventory valuation. So inventory valuation is important for identifying your revenue, and then valuation of your stock to identify your actual profit, and also to know your liquidity position, and also to comply with the laws as per your Companies Act, where it says you should comply with accounting standards for preparing your financial statements. When I come back to basic valuation, which we discussed in the previous one, like cost or NRV, what is cost basically? Cost is nothing but the cost at which you purchase. We pay some money, right? And all the other incidental expenses to bring the stock to the current location and condition, and the conversion cost. What is the meaning of conversion cost? Conversion cost means what? The labor and the overheads incurred on the material is called conversion cost. Your total cost includes cost of material as well as cost of your total cost includes cost of material as well as the cost of a conversion. So cost of purchase and cost of conversion and other important costs which are used in manufacturing a product, a final product. So a product cost comes from the data which is available with us in the form of cost of raw material, cost of labor, cost of the general overhead, fixed overheads, variable overheads incurred on that particular product. Now, though there are certain costs which are to be included, but some costs which we should not include. Number one is any abnormal wastage. Abnormal waste or abnormal loss we should not pass on to the customer. It should be charged to profit and loss account. At this we discussed in our very basic classes, where normal losses only to be passed on to the customer. Abnormal losses should not be passed on to the customer. And number two, storage cost. Storage cost should not be added to the cost of material unless it is necessary. It is necessary to be kept under the storage. And then all the administrative overheads should not be included in the cost of. Only production overheads are to be included in the cost of raw material or finished good. And we should ignore selling and distribution cost, because these are the costs incurred after the material is ready, that after the good is ready. So the post-production cost should not be included in the value of inventory. It means the cost should be material, conversion cost and production overheads. Most of the thing is production overheads. When it comes to net realizable value, we discussed, that is selling price minus selling cost or selling expenses to sell the good. So we understood what is cost and we understood what is NRV, and this is exclusively for finished good valuation. Which valuation? Finished good valuation. There is a different valuation for raw material and work in progress, and work in progress always at cost plus conversion cost, purchase cost plus conversion cost. Raw material generally at cost. Only in certain occasions a raw material can be valued at replacement cost. Only in certain occasions a raw material can be valued at replacement cost. Otherwise, raw material shall be always valued at cost. When a raw material shall be valued at replacement cost is what we are going to learn in the next post. Thank you.